Yo. So I was trying to explain to my family how a credit spread works, and I realized most people are kind of getting into the stock market right now, but most people actually have no clue what to do other than buy Apple. So let me give you a primer of just how the total stock market works. The first thing you need to know is that the stock market, there's different kinds of stock markets. The most common one, the one that you probably heard of, is the North American stock market. Now, why is this special? It's because, well, not even North American stock market, specifically the USA stock market, which comprises of the NASDAQ, the New York Stock Exchange. There's a few other stock exchanges. Now, why is the US stock market more important than any other stock market in the world? Well, it's pretty standard because all the main companies, the tech giants, Google, Apple, all of those are based in the US. So if the US economy is good, that's partly due to the fact that Google is performing good, Netflix is performing good, Amazon, Microsoft, all these companies, they're either in the NASDAQ or the New York Stock Exchange, which again represents the North American stock market. So if you want to invest, the first thing you're going to do, you're not just going to go into the stock market and buy a share. You got to open an account, and mostly the banks kind of open the accounts for you, and they only allow you to trade in North American companies by nature because you won't have access to companies from the Chinese stock market, let's say, because they just don't have the correct deals with them. And right now with the trade tension, again, I can rant on about that, but it doesn't really matter. What you need to know is, how do I buy Apple? And it's pretty straightforward. You just have to literally, what you're doing when you're buying a company is you're literally buying a piece. One share is one piece of the actual company. So if Apple has 10 million shares and you buy one share, you're technically a minority owner of Apple. So what does minority owner of Apple even mean? Well, it means that you're entitled, in theory, to have a representation in their voting decisions because it's a public company. So let's retrace all the way back. What the hell is a stock market? Anyway, why do people buy and sell parts of a company in the first place? Well, the main reason a company even sells a piece of its own pie is to raise money. That's the foundational reason why the stock market even exists. It's because a company, let's say something like Apple, they have the vision, they have an iPhone. Let's say you invented the iPhone 10 or whatever, and you have nobody to sell it to because you don't have enough money to make 10 million iPhones to give to the market. So what do? You put your company in the stock market and make it public so that you have the right to raise money by giving away a piece of your company. So you're exchanging shares for money, essentially. Now, why is that an important thing in the first place? It's because the second you put a number on how much a share is worth, suddenly you're putting a number on how much your company is worth. So let's say when you put your company in the stock market, you're like, I'm gonna make my shares $10 per stock. What you're essentially doing is you're telling the market that, hey, this company is worth $10 per share multiplied by however many shares you have. So let's say you have 1,000 shares, so it'd be 10 multiplied by 1,000. Now, in the case of Apple, Google, these guys have millions, if not billions of shares. And each of those shares can go from $100 to $400, $500. So now let's say you own one share of Apple. What you're basically doing, you're not doing it for the voting rights of the company or anything like that. Because at the end of the day, you probably won't be making the large decisions that change the way Apple products are made. What you're really doing is you're trying to buy a share for cheaper than what you're selling. So that goes with the ancient principle of, buy low, sell high. That's generic stock market money-making tactics. But most people mess up because they buy high and then they sell low. So let's just do a real quick recap of what's going on here. There's a stock market which is compromised by a bunch of companies that went public. And each of those companies are allowing you the right to buy a piece of their company for a certain price. That is essentially what the stock market is. That's why it's called a initial public offering, not a private offering. There's a whole market for private equity firms as well, which is apparently way bigger than the public market. But that's a different story altogether. The interesting thing about stuff like this is the first corporation that was actually doing this is called the Dutch India Trading or East India Trading Company, but it was a Dutch firm. So I think it was totally called Dutch East India Trading Company or something like that, which was basically a trading company. However, to mitigate the risk, they went public and allowed anyone pretty much to buy shares from the chunk of the big pie. What this does for the company is it reduces risk. Because if you have just one owner, let's say me, or rather you open a company up, you make $100, that's your $100, you earned it. However, if you lose all your money, that's on you. You're not mitigating any of the risk. You're losing 100% of your money. When you put a company out to the public, you're not just you. You're now you and everybody else who has a piece of the pie that you gave out to the market to have their way with it or whatever. And in doing so, you reduce risk a tremendous amount, because now it's not just you're at stake, but now everybody else who's invested is also at stake, and you have a reduced risk level compared to what you initially had. Because what happens is these companies, they don't just go public. There's no such thing as going public. You get put into an exchange in order for you to access the public in the first place. Now, before, they used to literally just write in a piece of paper and they'd just give you a share, like, hey, this is your part of the company. But that's not how it works anymore, because everything's so digital that the second they go into this exchange, anyone can buy it. You're not given like a literal piece of paper. You're kind of given this digital receipt that allows you to claim a certain amount of shares. All right, so bringing it back, you just bought a stock of, let's say, Apple. You put a buy order in for a certain price and it goes through. Now what do? You're just sitting on the stock? No, of course not. You're kind of hoping that the stock goes up. Conversely, you don't want that stock that you bought, let's say for $100. You don't want it to go down in value either, which is what scares most people about the stock market in the first place. Because when they see that a company that they bought, let's say for $100, and then suddenly that $100 is worth now $87 because the market crashed, they think, oh, that's the end of the world. Well, no, what's happening is it went down 13% from the top, whatever that was. So all the shares that was issued by the company went down equally that much. So that's why they say the company performed bad. But really what's happening is it's just a buyer and seller market, just like any other, like let's say a fish market. You're buying and selling fish where you negotiate prices. Literally the stock market is the exact same. However, the negotiations, there's so many of them happening at the same time that people can give you an exact price every day. But really it's made out of a bunch of bids and a bunch of asks. All right, so what's the cardinal rule of the stock market? Well, everyone's gonna tell you their own little rules, but this is a rule that Warren Buffett sticks to, and I think it's the most solid, because Warren Buffett, if you don't know who he is pretty much the most successful investor of all time currently. And he basically, that dude just makes so much money, it's disgusting. Like you can't really even fathom this guy's level of wealth. Anyway, that dude says, when you buy a company, you gotta buy companies that are undervalued, number one, and number two, you have to hold them forever. Now, that's interesting, right? Why would most people buying a share is only buying it to sell higher? They're not looking to hold forever. And yet this guy, who's touted as the most successful investor of all time, is saying hold forever. So what's going on exactly in that philosophy? So the philosophy is pretty straightforward. You basically, what you're doing is you're allowing the company to grow as it's supposed to. And in fact, if you think about how the stock market was, why it was created in the first place, it wasn't for short-term profit. It was to invest in companies so that you retain an equity ownership and also retain certain profits that come with that ownership. But if you look at companies now, they barely pay a dividend. So ownership is kind of out of the table unless you're one of those insiders that own a chunk of the stock. Which again, if you don't have a gazillion dollars, it doesn't really make sense to start buying equity stakes in a company. But the fact that Warren Buffett is giving that advice, it's still not changeable. Because at the end of the day, what happens is, let's say like with Apple, let's say it's trading at the $100 range or something. I'm just gonna grab a seat, fucking tired as hell right now. All right. So let's say Apple is trading at $100 and suddenly it starts trading at $120 per share. In theory, you just made a 20% profit because you bought for $100 and now it's going for 120. Now conversely, going back to the $87 rule, not $87 rule, if it crashes to $87, what just happened? You've lost $13 of equity because you bought at $100. So that's bad news for you. So let's bring it back to Warren Buffett's advice. Why is he saying hold for life? It's because when a company goes down 13%, what he's actually saying is that in the long run, companies are always going to be going up, which is very interesting if you think about it. In fact, if you zoom out on the S&P 500, it pretty much looks like a straight up, like a diagonal up line all the way for the last 100 years with little blips here and there. So that thing that happened in February with the market crash, if you zoom out far enough, is actually just a blip. So his theory kind of did prove true, especially in this market where Apple did crash. It went down like almost 50% in value. And then it made up all that money and then some. So when Warren Buffett is saying hold for life, what he's saying is don't have weak hands where when you buy a company or when you invest into a certain company that you're gonna give up just because it has a 5-10% loss. You gotta hold it through, and maybe it'll go down 30-40%. But what he's saying, and he's got billions of dollars to prove it, is that if you hold long enough, you will make money in the stock market if the company has a correct moat. So in the case of Apple, what's happening? They basically dominate the fucking market. So if you have a company that's so dominant, obviously they're going to eventually recover as the economy recovers. However, when the economy crashes, pretty much everything crashes. That's just the nature of how business works, because most people just stop buying. If you're not buying iPhones, if you're not, god damn, I'm telling you, don't get into cannabis companies. Your lung health is gonna just... All right, so what was I saying? Just to recap, buy companies that you really believe in and then hold for life. And if you follow that principle, companies that are undervalued that you believe in and you can hold for life, then essentially you're following what Warren Buffett's philosophy is. However, why is Warren Buffett a gazillionaire and you have no money? It's because the way Warren Buffett does it is almost surgical. He goes over thousands and thousands of companies and looks at the actual revenue. How much money is coming into the business and how much money is leaving the business. If you can see that, again, it's all common sense if you know what you're looking for. So if there's a company that's, there's $1 million coming into the company, but the company's bleeding $2 million, obviously it's losing a fuck ton of money. And so because it's always losing money, even though it's dealing with millions of dollars, it's actually a detrimental company for your portfolio. So like, let's say in the example of the Snapchat that I bought puts against Snapchat. Why? Because fundamentally, if you're making $2 billion of revenue and you spend $1 billion on research and development and another $1 billion on just upkeep costs, guess what? Your $2 billion, even though you're making $2 billion, just to make sure that the office is running, it takes about $2 billion. Then you're not really making money. You're kind of breaking even. So how do you raise money when you're a company like that? Stock market. You just issue shares and you dilute the pool, but in return you get some cash from other investors who are equally just looking to buy and sell for their own gains. So the stock market in a like a full picture kind of detail is literally that. It's all these different small companies dealing with their own balance sheets and barely trying to survive. And only a few companies thrive, which is why it's pretty easy to pick them up. Like the fact that Google, everybody in the planet has to use Google, no matter if it's COVID season or not. So you can logically surmise that maybe Google is a good buy because generally speaking, unless the internet dies, which is also possible given the current climate, unless the internet actually dies, Google is going to be prosperous. That's just common sense. Again, there's always an if. In this case, if every government destabilizes the internet by splitting Google search engines into Baidu and this and that, like China's doing it right now, and they've been doing it since time. But if every country starts doing it, then you're going to have yourself multiple versions of the internet, which is going to be pretty disconnected world if you think about it. So I hope that doesn't happen. All right, so in conclusion, the stock market is just a bunch of companies in a market that's public, that allows anyone in the public to buy shares or a piece of that company. And the way you make money in the stock market is by buying low and selling high. And according to Warren Buffett, the real way to actually make wealth in the stock market is to buy companies you believe in and holding them for life, because the returns on those are allegedly higher than if you bought penny stocks or things that are more obscure. So, and that's another trap a lot of people fall under, which is that, you know, people think that if something is making a lot of money, you got to get in that opportunity right away or you're going to miss it. But if you look at any point in history, literally every year there's some random opportunity. There's a random way to make $1 gazillion off some random pop off of a company. So really the game is patience. You got to pick the right companies and you got to hold for long periods. And it's not patience in the sense that it follows any traditional timeline, because stocks can pop off. They say decades can happen in minutes and nothing can happen for decades. That's kind of how the stock market really works. And if you understand that, then you have yourself a pretty good grasp of how to make money in the stock market. So yeah, I don't know if you learned anything from this. I do hope you invest, because at the end of the day, it's not free money, but it's money on the hard work of other people. So if Apple really works hard and gets a lot of sales and you just happen to own an Apple share, well, you make a bunch of money based off their hard work, which is why CEO interviews and all that stuff is a very important thing to actually note, especially when it comes to investing and the stock market in general. I wasn't into politics at all until the fucking election season came about and all these government people are talking about stimulus packages. Why is that even relevant? It's because those packages directly go into the pockets of Apple. When you get a stimulus check and you're balling with money and you have a shitty phone, most likely you're gonna buy an updated phone because now you got some more money in your pocket. But that's not just you, that's pretty much everyone. Anyway, I'm back to where I was. I hope you invest. Peace.